I'm coming to you live from Melbourne tonight. I'm here in my office behind me. We've got a few businesses that share this office, and I'm here in a big boardroom. You can look us up on any of your favorite search engines, and you'll see that we're on Flinders Lane here in Melbourne. And it is a really, really nice part of the world, especially when it's a bit cooler and all the restaurants are packed inside. It's nice and warm. So hello from me. Tonight we're being joined by Alex from Selfwealth. She's also going to be behind the Selfwealth name. If you see Selfwealth in the live chat just there on the side or below, depending on what device you're on, you'll be able to say g'day, and either Alex or myself will say hello back to you. Tonight we're going to be doing a slightly different episode. We're talking about the portfolio at large. So if you're a Selfwealth Live regular, you will know that we have two portfolios that we create and build on every week. They're called Low Tofu and High Steaks, as in STEAKS, as in a steak, like a piece of meat. And each of these portfolios, we try and add a company or an ETF or a listed investment company to each and every week. And so in these portfolios, we've mentioned so many companies like BHP, Apple, Tesla, Zscaler, the VHY ETF last week, Metcash, so many different companies. We're going to do a bit of a portfolio recap because that was one of the things that came through to me this week, which was, hey, can we do a bit of a recap in the episode? I'd love to know how things have gone. And that's what we're going to do tonight. I'm also going to tell you where I would invest $3,000 if I had $3,000 today. The reason why I chose $3,000 is that according to different outfits, depending if you go to an accounting practice or if you go and you file your taxes directly, many people in Australia will get a tax refund this year. And when they get their tax refund, it's typically between $2,000 and $4,000. So I chose $3,000, which is right in the middle. And I thought, well, what could you do with $3,000? You could go on or put it towards a European adventure, which I know so many people are doing. You could put it towards a long-term savings goal. You could pay off debt, or you could invest. And if you're investing, what are you going to invest in? Well, hopefully tonight we can talk a bit more about where I would invest if I was investing today. And just before we get started, I'm just going to switch my headphones off because last time you may remember that they caused a bit of an issue with our Selfwealth Live. So here I am. And as always, my name's Owen Rask, and I'm joined behind the keyboard by Alex from Selfwealth. Remember that any of the content and any of the material that we cover tonight is limited to general financial advice only. It's not personal financial advice. You can see a financial planner for that because we simply don't know your needs, goals, objectives. So be sure to head to the financial services guides that are available on the Selfwealth website or are available on the Rask website. As always, I start with a bit of a joke or a pun. Because it's tax season, I'm continuing the flavor from last week. Hopefully Jeremy or Plant One or someone, maybe even Pocketful of Shell, can give me a score out of 10 for this one. I tried this on in the office and it didn't go down too well. So full disclosure there. My joke is as follows. I tried paying my taxes with a smile, but they still demanded cash. That's my joke. It's tax time. I think I get extra points for that. What do you reckon? What do you reckon? Yeah, Jeremy, that's right. Alex, maybe Rob has changed his name, but no, Alex is joining us today. She's joining us from here in Melbourne, which is fantastic. So I hope that joke resonated with you, Jeremy. I'm just going to get a score from you. Hopefully that's okay. 3 from Jonathan, 0 from Celine. Oh, God, this is a tough crowd tonight, I tell you what. Jason, 3.1. Oh, 10 out of 10 from Shell. 10 out of 10 for worst joke. That's my worst joke? Come on, well, someone else has got to give me a finance or investing joke. It is so hard to find these jokes every week. I keep trying to come up with them and they just get worse, it seems. Okay, so let's get into it. As you know, the usual protocol, Jeremy's given me an 8. Thank you very much. Genevieve, a 2. The usual protocol is that we're going to guess the top 5 most bought and the top 5 most sold shares. And I can give you a few hints. This week, we're including ETFs. Actually, no, we're excluding ETFs because it would have been VAS at number 1 most bought. But that was the only ETF in the top 5, which surprised me. But this week, we're doing the top 5 most bought shares and the top 5 most sold shares. If you guess both correctly, you get some free trades from Selfwealth, and I'll also throw in a value investor program. That's our most premium online course from Rask Education, worth $499 to anyone who guesses via the live chat the two shares, the most bought and the most sold. Let's get into it. Okay, I'm going to share my screen with you really quick. So here we are at Selfwealth. I've got my dashboard. I'll zoom out a little bit just so you can see everything, and we can see how the market has fared today. And we can see not a very positive day for a lot of investors. Yesterday, which was surprising to me, but then again, I shouldn't be surprised. I've been doing this long enough. The ASX actually rose after the RBA announced interest rate increases. So when I look at the ASX 200 here in Selfwealth, by the way, I'm just looking at the ETF, which tracks the ASX 200, which is the STW ETF. There is another ETF, the IOZ ETF, which does a similar thing. So the ASX 200 actually, had a decent day yesterday. Some of the banks were a bit mixed, but for the most part, increasing interest rates saw the stock market actually increase a bit. And why? Well, it's because inflation, according to the RBA, may actually be able to be contained. At least that was the kind of more positive spin on the outlook for interest rates and the economy generally. I just want to bring up something here before I see all of your guesses come in. I can see Mark's guessed from Facebook. He's guessed BRN, brain chip. Isn't it interesting in the stock market how first we were worried about the economy not doing well enough in COVID and the stock market rallied. Then the economy did too well, and we were worried about it doing too well because inflation was high. And now we're worried about inflation leading to higher interest rates, which then brings on a recession. So now we're worried about a recession. Isn't it fascinating? I've been doing this long enough, and every single day I wake up, there's something else to worry about. So what's the takeaway from that? Well, there's always something to worry about. And there's that famous saying which goes, the market climbs a wall of worry. Everyone is worried continuously. So you can expect, if you're going to be a long-term investor, as I am, you can expect there's always going to be something negative. As Jeremy just said, oh, no, he didn't say it, but it is like there are perma bears, people that are always looking out there and saying there's something bad. That's just human psychology. Okay, so we can see some guesses have come in, and I'll just start rattling them off. Connor's guessed LKE, most sold, most bought Macquarie. Errol's guessed the same, actually. Interesting. Maybe you guys are sitting next to each other. Trove has guessed bought Combank, sold AGL. Stevie's guessed Zip for most bought, most sold Woodside. Good evening, Umbrella Lemming. Just managed to catch Owen's joke. It made me smile, so I'm giving it a 6 out of 10. Well, thank you. There we go, 6 out of 10, and some good words there. I like that. Okay, so don't worry, be happy, says Chris. I like it. That's a good motto for investors. Okay, let's get into this. So the most bought, and I'll start at 5, 4, 3, 2, 1. Most bought coming in at 5th is Westpac Bank. The bank that I often say has struggled quite a bit. If you include dividends, the return from owning Westpac shares hasn't been that bad, but that's in at number 5. Fan favorite Core Lithium in at number 4 for the most bought, has recently been down. This is something that we've covered a lot recently because really early stage business, and it's a business that has performed incredibly well. You zoom out, but remember it's coming off a pretty low base. Like the share price was only 4 cents not too long ago, so keep that in mind. At number 3 on the most bought list, which is probably not such a big surprise, is BHP being the big Australian, one of the most well-known companies. It's got a stellar dividend. Now, what's interesting, and I'm going to just check this really quickly. If we look here in the measures for BHP, and this is in US dollars, so keep in mind. Actually, we're looking in Aussie dollars because it's got it here. If you look at BHP's earnings per share at $4.05, and you look at the full year dividend, so not just the last dividend, but the full dividend, if we go into financials, and we'll get rid of these two things, and we'll scroll right down the bottom, we've got dividends per share, or DPS, and we'll look at, say, maybe this earnings per share. We'll see if it shows me what I want to see. So here we can see in the last year, we can see that the dividend in this pink line is greater than the actual profits per share. So this is an example of where the data isn't up to date, because what actually has happened here is BHP paid a big dividend because it sold part or divested its oil and gas business to Woodside, which then became Woodside Energy Group. And the data showing us profits, it had all of the oil and gas. And we're seeing dividends look like it's because when it made the divestment, it also paid a big dividend. So it looks like it's more profitable and it's paying a bigger dividend. But you could probably expect that to come back to reality in the next little while. So don't be fooled by that, I guess, is my takeaway. In at number 2, we've got Fortescue. Fortescue is popular lately because of the commodity cycle, I shouldn't say super cycle, that was quite a while ago. Many reasons to like Fortescue if you like the outlook for commodity prices, in particular steel. Here's a fun fact, which I often remember when I think of commodity plays and those that are particularly focused on China. And I don't know, maybe some of you have heard me say this before, but in China, I think in 3 years, they used or made more steel than the American economy did for 100 years. That gives you a sense of the scale of the steel that was required to transform the Chinese economy from I guess, resources-led to consumption. So they've gone from, over the last 30 or 40 years, a massive middle class booming, and now they had to build roads, rail, those ghost cities, which we heard about many years ago, all of those things. Now we're seeing a property boom, required steel. And what's the key input for steel? Well, it's iron ore. So that's where Fortescue, Vale in Brazil, BHP and Rio Tinto have made their billions. So in at number 1 on the list, a few of you guessed this, it is Lake Resources. Lake Resources has been the most bought, almost sold for a little while now. And you can see here, it has really, it has fallen off a couple of cliffs on its way down. This is quite normal when you see early stage businesses or when you have where management team play a big role in the business and they may depart. It's pretty normal. It doesn't make it any easier to say that it's normal, but it is pretty normal. Okay, so Genevieve, you've got most bought as Evolution and most sold Zip. Interesting. Most bought, Anthony says 0. Most sold Pilbara. 0 is an interesting one because it has fallen quite a bit lately. We can talk about that tonight too. Jeremy, yeah, LKE most bought. I know. Stevie, you said, oh, well, LKE is quite a surprise considering Steve left. Yes, absolutely. Jeremy said, is anyone else getting little dropouts in Owen's audio? Well, I hope not. Let me just check my system on my end. It looks like my audio is recording. Please let me know if this is bad. I can try and solve this problem. And okay, so now we've got the most bought. 5, 4, 3, 2, 1. Now we're going to talk about the most sold. So a few of you did guess top 5 most bought. If you can guess the top 5 most sold, then you're in the draw. Or actually, you don't even need to go in the draw. If you guess both, most bought, most sold, you get the award. So let me know what you think. If these audio glitches get really bad, please let me know, because if they continue, I can try and figure it out. Agnes says it's okay on my end. Yeah, I think depending on internet connections, it can get a bit glitchy with this software that I'm using. So let me know. If it gets really bad, I'll try and do something about it. Okay, so in at number 5, my list of most sold, Fortescue Metals Group was number 2 most bought, also number 5 most sold. If we scroll down, we can see why people are selling. So from selling, we see 32% of people are taking profit. So if you're in Selfwealth and you click sell, it asks you to just give us a reason why. And you can see that 32% of people that are selling are taking profits. Of those who are buying, most people say it's a good dividend stock. And I'd probably agree with that. Fortescue has done a tremendous job of paying dividends over the years, despite many, many, many issues. In at number 4, this is going to disappoint people, and I'm sorry. In at number 4, we've got Zip as the company that is, I guess, very, very, very topical at the moment. For those that know, Zip is the buy now, pay later company, which really caught a lot of, I guess, attention over the past 3 or 4 years as it pursued what I would call a roll-up strategy. A roll-up strategy is where a company acquires other businesses or other smaller, adjunct businesses in the hope of bringing them together, kind of like a roll-up, rolling them up, and hopefully thinks that bigger is better. Obviously, in buy now, pay later, Zip was coming up against the likes of Block or Afterpay. It was coming up against Klarna and many other businesses that entered this space pretty early. But Zip was one of the earlier adopters here, providing credit checks as well. But it's a business that has struggled in recent times. And the big reason, I don't know if we've got a moment just to quickly look at the financials. I'll see if I've got the financials in front of me. And we'll see here at the quarterly financials, and we'll go down and we'll see if we can go down to, it doesn't have, where are we? I might actually go back and see if we can get announcements from the company, because there is one particular announcement I'm looking for. No, it's not here. So I will revert back to that. But what I was going to try and show you is Zip actually has a line in its financial statements which shows you the losses that are expected to be incurred by the company for lending, and those losses appear to be quite severe at the moment. So investors are quite worried, even though revenue is going up like this, its ability to produce a profit might actually be further away than many people expect. And so we can see profit going in directly the opposite way. And this is a problem not just for Zip, but it's a problem for banks as well. But the difference is banks are higher quality lenders. They lend to mortgages and those types of things. So that's the primary difference with a bank. So in at number 3, we have a business which has made its first time appearance on the list, which is Whitehaven Coal. I'm actually surprised that this business is amongst the top sellers. The reason for this is that, and if you are a bit shrewd, I would encourage you to go in and have a look at this financials. So Whitehaven Coal, what does it do? Well, it's a coal mining business. So this is a business that a lot of investors simply invest in. We can see its revenue over time here. I'm just going to get rid of that revenue figure. And what we're going to look at is dividends. And we're going to look at the profits per share. So this chart here inside Selfwealth shows you the analyst forecasts for the profits per share or earnings per share, that's EPS, and the dividends per share. Now, what you'll notice is that analysts are forecasting a dividend of 84 cents per share, right? And the share price is $4.65. So if we were to do some quick mathematics, let's go that. So 84 cents divided by $4.65, it's an 18% dividend yield. That's effectively what analysts are forecasting for Whitehaven. Now, you will be sure to remember that all the forecasts aren't always the most reliable metric to consider, but we can see in the financials that analysts are forecasting a pretty consistent dividend going forward. You can't see it here, sorry, but in the future they're forecasting pretty consistent dividends for this business. And it's not the only business. So in the coal mining space, the trades at a really low valuation. And this is probably the other side, if I can just bring it back to me for a second. This is probably the other side of the ESG trade. So when we look at companies that are focused on ESG or environmental, social, and governance factors, we're typically looking at companies that operate in capital light industries. So industries like technology, industries that are focused on that type of very good for you, good for the planet type of investments. But when it comes to businesses that are involved in traditional heavy industries like fossil fuel, we see companies like Whitehaven Coal or New Hope trade at much lower valuations, because what happens is big institutional investors, like let's say an example is Australian Super or whoever, put pressure on these companies, and they don't, because they're getting pressure from their members and their pensioners and all these types of people to say, don't invest in coal, don't invest in coal. So they stop investing in these businesses and the valuations go down. Stevie, you've said Whitehaven Coal is surprising considering how much money they've made last quarter, paid off $400 million of debt and started a $400 million buyback. Well, that's correct. And this is what we see, Stevie. And as you know, when these companies do look so cheap, management also know that. So they start buying back their own shares as opposed to paying a dividend. Pima, you've said most analysts fail anyway. Yeah, they do. Yeah, they do. And Pima, you are listening. Abdul, you've said, I am curious to know when the short selling is made available on Selfwealth platform. That's a good question, Abdul. For any of those feature-related questions, what I would do is direct you to selfwealth.com.au. In the bottom right-hand corner, I believe it is, there's an instant support widget. The team will be more than happy to help you out there. Okay, so I don't think I've made it through my list, so I'm running behind schedule as per usual. In at number 2, we've got BHP being the second most bought. Let's just have a quick look at the financials. The forecasts, and let's have a look at the forecast for dividend yield. Now, if we go to dividends, we can see here companies forecast to pay $3.64 and $2.77. To Pima's point, I am not saying that this is going to happen. Analyst forecasts are often wrong. There's a saying on Wall Street, often wrong, never in doubt, which basically means, oftentimes financial analysts and economists and everyone else can be wrong. And yet it's not until after the fact that you realize how wrong they were. But I just like to look at those because chances are many of those analysts know the company better than I do. I don't follow BHP that closely. So for me, just having, I guess, a quick read on it is really important because I'd rather look at the analyst forecast than say the historical results. So we can see here revenue and profit from BHP over time is pretty impressive over time. And you'd expect that from a diversified commodities business. Okay, in at number 1, I don't know if anyone guessed this at all. But in at number 1, we've got LKE. So Lake Resources is the most bought and the most sold this week. So I'll bring this back up for you so we can see it here properly. So we can see Lake Resources, the most bought and the most sold. If we go down to the reasons why, of the people who are buying, people say it's undervalued. Of the people who are selling, they're taking profits. Now, many of these lithium companies, I've got to admit, it's really not my cup of tea. I'm going to say it out loud. They're really not my cup of tea. Core Lithium, Lake Resources, they're not businesses that I am in a rush to own. I don't really buy any early stage mining just because I don't really have the ability to forecast these things as well as the next guy or gal. So I kind of leave that to other people, and I'm happy to stick in my pond over on the side here, which is technology, industrial companies, and so on and so forth. So LKE, most bought, most sold. I don't know if anyone did pick both. If you did pick both in the chat, please let us know. You can send an email to marketing@selfwealth.com.au, marketing@selfwealth.com.au with proof of your YouTube handle or your Facebook handle, wherever you're joining us from, and you will get your prizes. Sandculp, you've asked a question, do institutional investors like Australian Super or other super companies buy and sell for profit booking during these uncertain times? And that reflects the most bought and sold. No, not for this one, Sandculp. There's 2 questions in this. The first one is that reflected in the data here inside Selfwealth? No, because the data that we use to collect the most bought and sold is actually Selfwealth. So Australian Super wouldn't be using Selfwealth to do that. They would have their own system for trading large amounts of shares, and it's typically like an institutional one. BB, you've said LKE most bought and sold. There is a lag, right? BB, yeah. So this is it comes from last week's data. So we look at the last week, today, and then next week we'll look at this week's data. So at Sandcup, just to the other part of your question is, do super funds manage their investments based on tax? Well, the answer is companies like big super funds, maybe not so much, but fund managers definitely do something that we call window dressing. Window dressing is where, like it sounds like you're shopping. Window dressing is when you receive a statement from your fund manager. So let's say you receive a statement that I'll bring it back to me so we can look. So window dressing is when, say, for example, last day of the month, you go out and you buy shares of companies that are the good companies, right? But you sell all the dogs, all the shares that you've held for a few months and they're not that good. Because then what you do is when you do your end of month report, the end of month report has all of the good shares in it. And you can say to your investors, yeah, we haven't done too well, but you know what? We've got these really good companies. See here. And that actually happens, I'd say, more than many people would care to admit. And that's more like fund managers saying, we've made some mistakes, but look how good our portfolio is. And that's called window dressing. And to give you an idea of how obvious this can be, sometimes in the last 2 or 3 hours at the end of the month of trading, you can see a lot of buying and selling activity happen really quickly. There's a belief amongst the investments industry that the investors who don't really know what they're doing, they're the ones trading in the beginning of the day. And at the end of the day, that's where the professionals trade, because they can see where the buys and sells are coming in and they time their trades around that. Now, I don't know how much you play into that. To be honest, I don't really care. It doesn't bother me. I just buy my shares. And if I've got the shares for the price that I want, I'm happy and I just, move on. But it's interesting when I hear of these things and I see them playing out in the market. So Jason did answer your question. Great follow up there. Stevie Owen knows me too well. My portfolio is full of dogs. So are you saying here, Stevie, that you are window dressing? Indeed. A good reminder here from Alex, just to say, remember that all of the content included in Selfwealth Live is limited to general financial advice only. B. Caddis, you said, maybe the machines buy at the start of the day, and they are right. Maybe they are, B. Caddis. Because sometimes, what most of us do, to be honest, is we set an order, say like here in Selfwealth or whatever brokerage platform we're using, we set an order and we set it for the next day and then we go to work, right? And at the end of the day, it was really, early in my career, it was impressed upon me, if we just look at the daily trades here for an ETF, it was impressed upon me that in 5 or 10 years, if I'm a long-term investor, am I going to remember the 1 or 2 cents that I missed out on when I was buying my shares? Probably not, unless it's like a competition that I'm in, which is not. I don't really mind. So here we can see, like, this is interesting trade patterns here. You can see this is just for the most diversified ETF, basically on the entire Australian Stock Exchange. And we can see how it spiked in the morning and then it went flat. Let's have another look at a different ETF. Let's say an ETF like, I don't know, ETHI, which is the ethical shares one. So we can see this throughout the day. It's probably more, there's probably more ups and downs, but it's, we've got to remember the axes here. We'll have a look at one more ETF. Let's say VAS, which is the most popular ETF in Australia. We can see here how it's jumped at the open. We can see the number of trades peaking, and then trades coming back down. And it's really interesting to see all of this data play out from day to day. You can try and interpret it. We don't necessarily spend too much time doing that. Just a quick call out, by the way, to I did make a bit of a cheeky announcement last week. You can see it on your screen here in front now. I did make a bit of an announcement last week that I was appearing with my co-host Kate Campbell on the Big Swinging Stocks podcast. I'll put it in the chat now. I'll put it linked to Spotify. The Big Swinging Stocks podcast is run by Selfwealth, and lo and behold, they invited me on. So here we go, Big Swinging Stocks. I'll put it in the chat. Big Swinging Stocks episode. You'll see it come through in just a moment. And there you go, Big Swinging Stocks. Available on all of the major podcast channels there. Rob's put in a lot of effort along with Alex, who's the host of the series, to make that series a success. It's fantastic. Nyundi, you've sent in a question. We often see the dividends per share become higher despite the share price drop. Is this the company's way to incentivize purchasing of shares, or are there other things happening, i.e. paying off debt, etc.? So typically, there's no right or wrong answer to this. I think this is a great question though, Nyundi. So here we can see Telstra, right? So if we go into the financials and we look at Telstra's dividends per share, so DPS is the shorthand, we can see over many years, Telstra's dividend was so consistent at 28 cents per share. There was 2 dividends a year of 14 cents, fully franked. So it was a little bit over 30 cents by the time you include franking credits. And we can see that it just cut the dividends because it realized eventually that it shouldn't be paying as much in dividends because it was transitioning away from the NBN. The NBN was coming and it needed to pay down debt and to actually reinvest back into its business. And there's no exact science for this, Nyundi. There's no exact science for, oh, well, it's paying this amount of dividends and the profits are this. But what we want to see as investors, or just what we want to be mindful of, if a company is paying, like say Telstra here is paying 10 cents a share in dividends over the full year. But then if we go to the earnings or profits per share, and I'll use the normalized. So if a company is earning more, so you can see here in the chart, it's got 19 cents is what the profit per share is for Telstra, pardon me. And we can see the dividends are 10 cents per share. That means that Telstra is keeping 9 cents a share to reinvest back into its business. And in episodes gone by, like when we talked before Christmas in particular, where we talked about using investment checklists, one of the checklist items that you will remember that I spoke about is this one under management effectiveness. It's called return on capital, or here it's listed as return on investment. Now, if we look at the average return on investment, this one right here, what this shows you, Niandi, and for everyone that's watching, is this effectively tells you for every dollar that Telstra has inside of its business, whether it's from debt or whether it's from the profits that it keeps, what is the return that it earns on that money? And you can see here that the return on investment is 8%. So the way this was described to me, Niandi, and it's something that everyone should remember, is imagine a company on the stock exchange is like a box, a cash box. Imagine that I just slide a box out to you in the middle of the table, you're sitting across from me, and then you put into that box $100. Well, after a year, that box would have $108 inside of it, because that is the return on the investment that you've made into that box, into that company, and it's invested the money for you, and now you can see it's 8% higher. So how does this relate to dividends? Basically, what we're trying to find as investors are companies that keep investing at high rates so they can keep growing that $100 that you've invested into it. And that's basically the measure of return on investment or return on invested capital. Now, the best companies in the world at doing this are companies like Visa. I brought this up as an example. If you think about Visa's business, it's incredibly strong. You tap your card, you pay Visa basically. And you can see 21% for the past 12 months, but the 5-year average is 17%. So that means every year Visa's growing its business 17%. Even if it pays a dividend, it can still grow. And that's quite incredible. So that's the essence of what we're trying to do in the stock market. And that's probably the best way to think about how much does it pay in dividends versus how much does it reinvest back into its business and earn a return. Bicatist, I can see your comments here. The Nikkei is lower now than it was in the 1980s. And you can say now Western nations are experimenting with quantitative easing and quantitative tightening, which has never been done before. What's to say we don't enter an extended downturn? And Bicatist, that is a fantastic comment. And the answer is I don't have the answer to that because I don't think really anyone does. We know that the stock market, and if we look at the stock market, we can see that it's performed exceptionally well over a very long period of time. But if we look at the bond market, I think the bond market's a fascinating place. And we can see that over 10 years, here's the Vanguard Australian fixed interest ETF, which is a proxy for bonds here in Australia. You can see that it hasn't really done anything. But if we look at, say, IVV, which is the US stock market ETF for the S&P 500, it's been up and to the right. And the reason that that's happened is basically interest rates have fallen. And I think, we're seeing interest rates rise for the first time properly rise for the first time in quite a while. One of the things that I'm comforted by, and people are very scared about this right now, but one of the things that I'm comforted by, Bcatist, is that remember that we do have a lot of debt in the world. And we do have, and that's often brought up as a really scary thing. Everyone's got lots of debt. Look how bad this is. It's never been this high. Yeah, but what that means is that if interest rates go up, they don't need to go up as much to have the same impact on us for our budgets to blow out. If you have a $1 million mortgage versus a $500,000 mortgage, interest rates don't need to go back to what they were for you to be hurting even more because your debt is so much higher. And so what we might find if we look at interest rates from 30 years ago versus 10 years ago versus now, it might be incorrect to assume that interest rates of the 1970s, 80s, 90s are relevant today. It might be a totally different ballgame. I don't really have an answer to that, but there's a fantastic person that you can follow on Twitter, actually, and the Twitter handle is Charlie Munger Fans. So Charlie Munger Fans, he talks a lot about Japan and why that might be a really interesting market for investment now. So, okay, I've been way off track. Sorry, guys. So, okay, I'm going to briefly explain how tax works, and then I'm going to get to the thing that everyone wants to know. What would I invest in if I had $3,000 right now? And then we can talk about that for a while. Okay, so how tax works on shares. So there are just some really simple, rules here that we need to understand if we're investing in the stock market. The first thing is there's a company called a share registry. The share registry is what connects Selfwealth or your broker to your company. They sit between Selfwealth and your company or your ETF provider, and they record your information. So when you invest in an ETF, you will receive a piece of paper, typically, unless you've signed up for digital mailings. Or if you buy shares in a company like BHP or Commonwealth Bank or CSL or whoever, a company will send you some paper. And on that paper, you'll have your share number, basically a reference number that allows you to log into your share registry. The most common share registry are Link Market Services and Computershare. Now, if you give these companies your tax file number, when you go to lodge your tax return in Australia, a lot of the tax information is pre-filled. So you don't need to really do that much. You should still check it, of course, and your accountant should still check it. But if you register your tax file number, it can pre-fill a lot of that information for you. When you invest in an ETF, you will receive a tax statement either via email or via post that tells you how much or what you have to report and where. Now, when you buy a dividend stock, say like BHP, and it pays you a dividend, you receive the cash in your bank account or via check, and you receive the franking credits at the tax office. Once again, make sure your tax file number is recorded for your shareholding in BHP. Now, what happens with an ETF is it's slightly different. Even if you receive a dividend from, say, the Vanguard VAS ETF or the IVV ETF right here, your actual cash payment might not match what you actually have to disclose to the tax office. So there can be there are many different components. There are a few different guides. Here's the one from iShares, and it explains what goes into an ETF in terms of how you record your tax position. Here's one from BetaShares, and I'll zoom in. They just show you basically what a sample of a tax statement looks like. And you can see here it's got all of the different tax amounts. And you put this into your tax return, or your accountant does it. And if you get multiple statements like this, you add them all together and you put them in your tax return. So that's how tax works for ETFs and funds that you might buy on the ASX. Your broker, like Selfwealth, can help you estimate your dividends and distributions. So I was speaking to Alex before, and later this month, it's expected that all Selfwealth traders and investors will receive their annual tax or their tax report. It's called an annual report, and that has an estimate of dividends and distributions in there. You can also use freemium tools or subscription tools. The one that's the most popular in Australia by far is called ShareSite, and this allows you to upload your investment information, and it calculates your returns, your capital gains tax. It estimates your franking credits, all that sort of stuff. It can still be wrong from time to time, but it's a pretty decent tool, and it starts at a free level and then moves up from there. So you can find out more information about ShareSite online. Just some final things, and I'll be quick here about rules. Franking credits are really, really important, and I'm about to show you a real example of why they're important. For Australian investors, Australian tax residents who are eligible to receive franking credits, they do make a big difference. If you hold an investment for more than 12 months, the capital gains tax that you pay, so you pay tax on the income that you receive, but you also pay tax on the gains that you make. Your capital gains tax bill is typically cut in half for an individual investor. This is something that I look to for a lot of people, and they don't realize this. This is something that is going to be more and more important to more and more investors over the next few years, probably the next 2 decades. A diversified index ETF is more tax efficient than a lot of the thematic ETFs that we know and a lot of the more concentrated ETFs. So what do I mean by that? Let's translate that into English for people. Inside this ETF, the S&P 500 ETF, there are approximately 500 different individual shares inside that ETF. Now, if one of those shares is swapped out for another one, the ETF will have to sell that share that it's swapped out and buy the one that's come in. So that creates a tax event because there's a sale and then there's a purchase, right? Now, if you go with an ETF that is much more concentrated, you're going to get more big tax events like that. I don't know if this is a perfect example because I don't know the turnover of this fund, but I'll use an example. There's an ETF that we spoke about last week. The BetaShares Top 20 ETF is an ETF that holds 20 shares inside of it and then does some other things like some trading around the edges. You might remember I described this ETF as an ETF or a managed fund. It's more of a managed fund than an ETF that does more buying and selling of options and derivative contracts. Well, what can happen is because it's doing more buying and selling, it can create more tax. So when we look at the returns, I had a question in the comments about this. When we look at the returns of the most popular dividend ETFs in Australia, if you look at the returns, they might not be comparable, right? Because we've got one ETF reporting a return of X, another ETF that's reporting a return of X, but one of them is bought and sold a lot more than the other one. Now, if that happens, you as the end investor, the person that owns that ETF or managed fund, are going to be taxed more because there's more buying and selling. It creates more tax events. And people aren't yet properly aware of that, at least in the retail investment space. And finally, you still pay tax if you have a dividend reinvestment plan. You know how a company might offer you to reinvest your dividends, or if you get distributions from your BetaShares or Vanguard ETF or whatever, you still pay tax. So you can't avoid the tax, man or woman, you still pay it. So that's important. Okay, so good questions in here. B Caddis, you said is brokerage deductible? Now, B Caddis, I'm not an accountant, so please speak to your accountant. You might be surprised to know that brokerage, according to the ATO website, is actually listed as not necessarily a deduction, but a reduction in your capital, your cost base. So let's say your shares cost $100 and your $10. It can increase or decrease your cost base to make it, and that's the way it's accounted for. Subscriptions can be if you've got income against them, I believe. But speak to your accountant. Jason, you said, given an ETF with capital gains, since they traded, do you see the benefit of the 50% tax discount? That's a really good question, Jason Marshall. So when a ETF is buying and selling inside the ETF, they will try and manage it so that you pay less tax. They try and do that for you let's say, for example, there was an investment inside the ETF that had been held for 360 days, right? They might take it at their discretion to keep holding that for another 5 or 6 days, which then benefits you because I should have explained this at the start, but basically an ETF, you can think of an ETF as it is the thing that holds your investments. It holds all of those shares inside it. But you as the end investor down the bottom here, owning into that, all the tax passes through that. So it passes through that to you as the end investor. Now, this is what I mean. We're seeing, like, I don't know if you remember last year, this time last year, if you were a Reddit user, a social media user, you would have seen the outrage when people had woken up on July 1st and found that their ETF was 10% lower. Now, this is because some of the ETFs in Australia have really concentrated portfolios. And when the ETFs sell, there's capital gains or profits that have to be sent back to the end investors. And what happened was at June 30th, all of those, all the accountants got onto the ETFs and calculated what had to be sent back to the investors. and the share price dropped. And that's because all of the capital gains and all of the things that needed to be sent back to the investors had to be sent back. So even though your investment, let's say your investment was $100 and then it fell to $95, the difference being the $5 is just that you would receive that in a distribution/dividend in a few months. And all of the usual rules apply, Jason. So the inside of the ETF, if there's capital gains tax discounts, those are passed back. So Jason, you said to elaborate, the ETF rebuys and sells to maintain its replication of the index. So there are situations where the share isn't held 12 months. Yeah, that's right, Jason. So I'll give you a tip here, and I'm going to show you how you can figure this out. And I'm quite happy to be the one that puts the pressure on these big ETF providers. But why don't we look at the Vanguard, I'll see if I've got it here, Vanguard VAS ETF. I'll see if this comes up. Now, I'm going to show you something here for tax reasons. It's really important. If you invest in ETFs, you should demand your ETF provider publishes this information. And I'm going to give a pat on the back to Vanguard because they publish it. You can see here that they publish after tax data as well. But see in this table down the bottom here, it's got turnover rate, right? And I'll just click on it. It says turnover is a measure of the amount of trading undertaken to manage the portfolio relative to the portfolio size. In English, what that means is, of all the shares inside, how many of them have been bought or sold, turned over? 0.7%. Now, if you have an ETF, which has a lot fewer shares, this has 305 holdings at the moment. If you had one that had 10 holdings and they were all the same weight, so they were all 10%, and one of them was sold, well, then you're going to get turnover of 10% straight away. And that creates a tax event. So one of the things that investors, I believe, are going to wake up to in the years ahead is that some of these ETFs that have come to Australia have more turnover and they're not disclosing that. And that's going to result in worse tax outcomes for investors. So I hope that makes sense. Shergill, you've asked, how do we know if our dividends are franked? So for individual shares, the company has to publish a report. So in BHP's case, I think we mentioned this. In BHP's case, they will have made an announcement to the ASX to say that their dividend would be franked. So you'll find that in the announcement. The other, you can use websites, and your brokerage account usually mentions if it's franked or not. But the other, with ETFs, you really don't know the exact amount of franking. So you don't know the exact amount of franking credits. But remember, only Australian companies can pay franking credits. B. Caddish, you said, Shergill, they are stated in the ASX announcements. Thank you. I should have just read the next comment. Genevieve, yep, you can also Google the ticker code and the words franking credits. Fantastic. Jason Toms, you've said, DRP caused many arguments with people when I worked at the ATO. No one believed it counted as income. Yeah, that's right. So just to double down, Jason, thanks. We've got an expert on the line. Just to double down on this, if you elect to receive your dividends as new shares in the company, remember that you are still receiving that benefit. So you're still receiving the income, you're just receiving it in a different way. So you still have to pay your tax. Okay, so I can see a lot of comments have come through. Okay, so B. Caddis, what have we got here? I'm just catching up on the chat. So Spark, only the whole shares? Yeah, okay, this is a good point from Gabrielle. So Sparky, you asked, does anyone know if you have a DRP and if the share price is more than the dividend, does it buy a fraction of that share? And the Gabrielle has answered this beautifully and said, no, it doesn't. Only the shares purchased and the balance is banked and added to the next dividend for future reinvestment. So this is important, right? I get this question quite a bit. And I'm sorry if we're getting bogged down in the geeky tax stuff, but this is what will save you money in the future. And I'll show you why in just a second. So let's say, for example, that we have the IVV ETF, which is one of the most popular ETFs in Australia, by the way, which you all know that by now. It is worth $562 per share or per unit, right? You have to have $562 plus a bit of brokerage to buy this thing, right? But if the dividend that you receive is only $2.08, right, and you've done a dividend reinvestment plan, you're going to need around, if my math serves me correctly, around about 250, 280 of these to make it valuable. So you'd have to have quite a bit of money invested in this ETF just to receive a dividend, which covers the cost of buying a new share. So what happens is the share registry typically holds on to your money if you've elected a dividend reinvestment plan for the future. So you should be mindful of that before you elect to get the DRP, before you elect to have a dividend reinvestment plan. So I hope that makes sense. Okay, so I can see everyone's made some great comments here. I don't have time just right now to catch up on it, so I'm going to continue with the next segment. But basically, there are some really simple ways to limit your tax. The first things are focus on being a long-term investor, 12 months or more. Make sure you're eligible for franking credits, and I'm about to explain why it's important. Target ETFs with low turnover. And if the ETF provider says, we don't disclose that, we'll say, well, you should, because that's what I need to know, because I want an ETF with low turnover so I can make a comparison with another ETF. And Stevie, you've also said, also remember to update your share registry in order to set up DRP or your bank details to receive the dividend. Yeah, so log in to ComputerShare, log into Link Market Services and read the paperwork that you receive. Please just do this. And then log in, it's super easy, put your tax file number in there, Bob's your uncle, away you go, you got better dividends. BB, you said, hey, if you are a long-term investor, one share each DRP for IVV means you will double in 500 years. Yeah, if you well, depends if it's a half year or full year dividend, BB, but yeah, I see what you're thinking. If you get $2 and it's $560, it's going to take a while. It's going to take a while. Okay, so the franking credits, why does tax make a difference? So I want to quickly show you something, right? Imagine if you invested in the ASX 200. So this is the Australian stock market. Just think of it, Australian stock market. Over the last 5 years, if you didn't include dividends, you would get 2.75% per year. That's your return. Speaking of Japan not doing too well, here's Australia. Now, let's add in the dividends. And this calculation sometimes takes a few minutes. Over 5 years, all of a sudden, it's 6.77. So we've nearly tripled our return, but just by remembering, hey, there's dividends too. We should include them in our calculation. Let's go one more. And let's say, and I think this is the right calculation, it sometimes takes a while. Let's imagine we also get franking credits from those investments. Now it's 8.21%. Now 3 to 4 times the amount if you just thought about the price. You know what most people do? Most people do when they go into Google is they push in ASX 200. Ding, XJO on the back does not include dividends. I think it's XNT does. This is the total return one. And that includes dividends, but it doesn't include franking credits. So you can see here the benefit of franking credits, the benefits of also getting dividends and reinvesting them are tremendous. Because remember, if you get a dividend and then you reinvest it, you're compounding on top of compounding. So you're getting faster and faster returns over the long term. And that's why dividends play a massive role in investing. So I hope it makes sense. And I hope we can all understand that. Now, I'm sorry that I've waited till the end of the show to share with you where I would invest money if I had $3,000, because $3,000 is just a loose figure for the tax return. Now, does anyone want to guess what I'm going to say? Does anyone want to guess what I am going to say as the thing that I would invest in? And it's only one thing that I would invest in. Now, there are many different things, and this is just one example. Does anyone want to guess? Jason, it's definitely not Bitcoin. I know you've done that just to provoke me, but it's not Bitcoin, not for today. NFTs, not NFTs, although I do have an NFT and it has done tremendously bad. It is down about 90%, which I am quite happy to say is probably the end of my NFT buying career. Okay, so someone has guessed it. Someone has guessed it. So a few people have guessed it. Raymond, you get the Effie, not quite. Okay, so I'm going to tell you what it is. And you're going to be like, oh, that's boring. But also, I want you to remember one thing before I say this, is that just because I would invest in this one thing doesn't mean that everyone should invest in it. You should see a financial advisor, because a financial advisor can sit down with you and determine your risk profile and everything like that. And I'll explain why that's important in just a minute. A new YouTube camera said BCAT. Hey, come on, my camera's not that bad. I think it's maybe a bit blurry. Okay, so here we go. Boring, and Jason's got it. So this is what it is. It is the VDHG ETF. This is what I would invest in if I had $3,000. It is every week, almost without fail, except for maybe this week. The VDHG ETF is the diversified ETF from Vanguard, and it is high growth, hence the HG, VDHG. There is VDBA for balanced, and there is conservative as well. And there's all growth, and there's a bunch of different ETFs as well. So if we just look back in and we go maybe to say, if we look back at ETFs, how do we get to other ETFs? Vanguard VDHG, and we'll see this come up in just a second here. The VDHG ETF is like a ready-made basket. So it invests in other funds within it. So it doesn't invest in direct stocks, it invests in other funds, and those funds have stocks. We can see the value of a $10,000 investment over 3 years and since inception. There we go. If we come down to the portfolio, what's inside it, we can see that inside of the VDHG ETF, there is actually the Australian Shares Index Fund, there's international shares, there are other international shares hedged. We can see there are bonds. There's only about 10% bonds in this portfolio, hence that's why it's high growth / high risk. And we can see all of the different mixes there. And if we come down, we can see distributions over time, just down here. And we can see they bounce around a bit because you do have certain taxable events. We can see the costs. Costs of 0.27. It's pretty reasonable. Remember, this is an ETF that anyone could invest in, but it's particularly focused on people that are looking for higher risk, higher growth. There are options for people that don't want that higher growth focus as well. So I hope that helps you sleep better at night. So I'll just answer some of your questions now. I'll be around for about the next 5 or 10 minutes if we want to have a chat about other things. I'm more than happy to answer questions. We will get to a portfolio recap in just a sec. Okay, so BB, you said VDHG is the most bought next week. Yeah, maybe it is the most bought next week. Sparky, you said, why do you need a financial advisor to invest $3,000 in VDHG? I'm just saying it's to protect my butt, Sparky. That's why I say it. So what else have we got here? We've got Jenny, you said a prize for those who guessed it. Yes, Jenny, I'm guessing you guessed it. So that's probably why you said it. It is definitely not Bubs Plant One. I did own Bubs, the shares for a little while, Bubs infant formula. It's made out of goat's milk. Good for you, good for the tummy, just like A2 milk. Give you a wink on the side there. It's good for your tummy. Is it though? We'll find out with the science later on. Okay, so there are many different ETFs that I could have chosen, but VDHG is diversified. It's from Vanguard. It's relatively low cost. It's many people use it as their first ETF because it is diversified, and particularly for younger people, it has that growth focus over the long term. So that's why they own it. Now I'm going to. Okay, so Sankup, you just got a question here, which is good. What's the difference between HNDQ and NDQ ETF? Which one is beneficial for an Australian resident investor? So let's just quickly dump into the platform here. HNDQ is the only difference is that HNDQ is currency hedged. So that means you won't benefit or lose from the difference in the Australian to US dollar. Mitch, can you please explain the RBA news this week in super simple terms? The media seems to be in a hype about it. Is it just fear mongering? Mitch, you're right. So when is the media not fear mongering? Let's have a quick look. So the decision by the Reserve Bank was to increase the interest rate by 0.5%. This is the interest rate that the banks pay. So this is how it is in simple terms, Mitch. This is the interest rate that the banks have to pay between themselves. So when they are circulating money around. Now, this is different to what your bank does. Your bank, and we saw in the news today, just today, CBA, Macquarie, and ANZ all increased their interest rates by 0.5%, the same amount as the Reserve Bank. Now, when interest rates go higher, like the Reserve Bank here, it's typically done to slow down the economy because we know inflation is too high. We can see the fuel, the price of bread, the price of lettuces, everything is too high, and the Reserve Bank doesn't like that. So it's increasing interest rates to try and control the economy. And that's basically, now in the stock market, what normally happens, Mitch, is when interest rates go up, that's bad for stocks. So that's bad for stocks. So that's something to keep in mind. But this week, the stock market was like, okay, well, it's not actually that bad. It's actually good to have some clarity around where interest rates are going. Okay, so yeah, as Jason said, RBA announcement was largely predicted and therefore priced in. Okay, so I did promise a quick look. We've got to look at the portfolio that we've put together so far over the last financial year. So 6 minutes, Owen, for my finish time. Okay, so here we go. I'm going to get through this as quickly as we can. There was a few comments over the past week that people wanted to see what was inside the portfolio, what we've talked about so far. So here it is. We can see over the past few months, since we started the program, Selfwealth Live, we've been adding one stock or one ETF, typically every week, to the portfolio. And we can see all of the different companies here, and I've just done them by ticker code, so it's not exactly very informative. We can see the worst performer by far is Square/Block. This is the company that bought Afterpay. Behind that, we've got Okta, which is the company involved in cybersecurity. Over on the Low Tofu side, we can see ARB Corporation, which is the bull bars business, and we can see BHP. Now, remember, I'm just looking at simple share prices here. This doesn't include dividends. So BHP has been, it's sold part of its business. So its share price is down because it's sold part of its business. So kind of take that out of the business. Outside of that, the best performer so far has been Zscaler, although it is extremely early days. Right after that, we've got ProMedicus and we've got Tesla right behind that. But what I would emphasize to each and every one of you right now is please, please, please remember two things. One, this portfolio that we're building every week is more an educational portfolio, regardless of whether you look at Steaks or Low Tofu. I, for one, I don't think in my life have bought 2 new shares every week. But that's what we're doing for the show because we're trying to introduce you to more companies and learn about how different business models or ETFs work. So I think the important takeaway here is that make sure that you remember that each of the things that we talk about each week, you should go away, you should do your own research on them, and you should really just treat this as a learning exercise. Maybe you pick up 3 or 4 things that you like and the rest you don't. The second thing is that these returns that I'm showing you on the screen right now are basically close to useless if you're a long-term investor, because long-term investing, in my opinion, is 5+ years, right? And to look at the returns now and think, oh, geez, I've made such a bad mistake. Maybe, but maybe we haven't. Maybe Square is a bad investment because it's down 32%. Or maybe in 3 or 4 years from now, it's a much bigger business and we've made a good decision. We just didn't get the timing right. And so that's something that I would just reinforce here now, that we didn't have, we've got a very short period of time to look at these results over. So I can see some questions. RK Musgrave, how do I invest in commodities? RK Musgrave, there are many ways to do that. Not the best way, just one way is there are commodity ETFs that are available on the ASX. So some ETFs say the thing in the title, like silver or gold. Sometimes what's actually inside the portfolio might not be. For example, there are ETFs that invest in gold miners, so the shares of gold mining companies. But then there are ETFs, like say the gold ETF, that invest in physical gold bars. There are many others. It's not a recommendation. It's just there are many others. Okay, some other great questions have come through here. Would you invest in IVV if you already have NDQ? So Danica, I know you're a regular on the show. NDQ is the NASDAQ 100 ETF and the IVV ETF invests in the S&P 500. Now there is going to be some overlap. For example, Apple, AAPL, will be in both ETFs, Remember that free Vanguard tool that I talked about, or the one from Morningstar? There are tools available online that show you the overlap of different holdings in the ETFs, or you can just compare them. You can just look at the top holdings for each ETF and go from there. Too old, too slow. You didn't add WDS to the portfolio. That's Woodside Group. I did not. So that's why the BHP share price looks like it's really low. It's actually not, because if I was a shareholder, I would have got WDS shares. David Bailey, where does the money go when the Reserve Bank raises interest rates? So basically what happens is what happens is the RBA does something called repurchases. This is or repo, and it's basically a mechanism inside of the central bank which controls money supply, and that is what forces up interest rates on overnight lending. So it's a bit complicated to explain on the show, but basically you can just think about the RBA is like pulling a lever or pushing a lever in the money market to determine where interest rates go. B. Caddist, I totally agree with you here, B. Caddist. Square bought Afterpay for $20 billion. I wouldn't say it's a bad business, Afterpay, but it bought it for $20 billion, and you said it's the worst trade ever. Well, we've seen what's happened to all of the buy now, pay later stocks since they bought Afterpay. If they had only waited 6 months. As a Square investor, I'm very sad about that. Craig, it's first in, first out done, or first in, last out done for taxation? I think is first in, first out done, or first in, last out done for taxation? Craig, that's a good question for your accountant, because I think it depends on how you've been doing it previously and how you intend to do it going forward, depending on many different things. Like, so for example, if you buy shares in BHP and then you elect for a dividend reinvestment plan, and you get shares in BHP, when you bought shares in BHP, the share price was $50, and then when you do the dividend reinvestment plan, it's $60. Well, that's a separate purchase at a different price. So I hope that makes sense. Your accountant will be able to help you more there. Stevie Stone, you could say that the same about Elon and Twitter. Yeah, I know. Had he waited 1 month, the market crashed. Yeah, imagine being Elon Musk, where you tweet to say, I'm going to buy a Twitter, and then the stock market crashes, and you get in a fight with them about some of the things that might be irregular in their books. I wouldn't want to be that person. BB, you've asked a question here. Why VDHG and not DHHF? Let's go back to the screen and let's have a quick look. DHHF. So the Beta Shares Diversified All Growth ETF. BB, just so you know, it's not fair to compare this ETF against VDHG, because this ETF invests in all growth, meaning that it invests in only shares, right? Whereas the VDHG ETF has 10% in bonds, right? So another thing that I don't know if I agree with this naming convention necessarily, but Beta Shares call this a diversified all growth ETF. And it pains me to think that some investors out there think that this ETF is diversified across asset classes, like across bonds and whatever, because it's just not. It's just not. The DZZF, however, is an ETF that might be comparable. So this ETF from Beta Shares has an ethical filter, and then it also invests in some bonds and in some stocks within the portfolio. So Ethy and Fair are in there, as well as an ethical bond ETF. It's really not that different from a regular ETF, to be honest. So that, I hope, explains more about it. B. Caddis, you've said, buy now, pay later is essentially credit without high profit margins. I shorted that all the way to the bank. Jokes. Linda, another great live session. Thanks for explaining things so novices like myself can actually understand what you're talking about. No worries, Linda. Thank you to you, and thank you to everyone that joined me tonight. I think this is a special time to say thanks to Alex, who's behind the keyboard as well, making sure we're all in check and providing some helpful resources throughout the night. So thanks to her. Thanks to Rob, who's put on this show this year so far. I think end of tax year is a great time of year to reflect on basically how have we gone? How have we gone with our performance in our portfolio? How have we gone from an income and taxes and budgeting perspective? Have we met our financial goals? Is it time to reset and start a new investment plan? Or how is our investment strategy gone? These are all really important things, and I think now is a good time to do it. Before you go, if you haven't already subscribed to Selfwealth on YouTube, please do so. And if you haven't already given us a thumbs up, please do that. And the final thing is, I've got a quote for you. I always end the session with a quote. So here's my quote, and it comes from the master himself, Warren Buffett. And he says, in business, I look for economic castles protected by unbreachable moats. You might remember from the sessions that we've had over the past few months that we talk about companies as having wide moats around them, really defensive business models that can withstand competition. The best businesses in the world have really strong advantages over their competitors, like Apple and Visa with its payments network, or Microsoft with its operating system. So I hope you all enjoyed tonight's show. Be sure to come back next week, next Wednesday, 6 p.m. I'll be recording in a different location next week, in a different state of Australia. I'll leave it to you all to guess where I'll be next week, and you can actually guess on the night. If you did correctly guess the top 5 most bought and top 5 most sold, please email us marketing@selfwealth.com.au. I'm Owen Rask. You can find me on Twitter @Owen Rask or on Instagram. Be sure to use the hashtag Selfwealth Live if you want to ask me or anyone on the team any questions. And just remember, even though we're talking about a recession, the stock market is still the place to go if you want to invest in innovation and long-term optimism. That's why I believe the share market works. So thank you for joining me tonight. I'm going to get back to looking at some more quotes by none other than Warren Buffett. Thank you for the great questions. I'll see you next week. Selfwealth Live at 6 p.m.